It's really a privilege on behalf of all of us at Peerage and all of our colleagues, partners, family, and friends to have this opportunity. I think, Douglas, we couldn't have a better time in the sense that, a lot has changed, especially even over the last 4 weeks. Transitory inflation doesn't look transitory at all. Rates are rising. Markets have been, we're in bear market territory. The divergence I find quite interesting of people's points of view, informed points of view about where we are, what it looks like, what the future of the next year or two looks like, and how it affects, the economy, real estate, inflation, consumer purchasing power, oil, and at the gas pumps, and how it affects the normal consumer is quite interesting. So we feel very blessed and privileged to have you, and your wonderful and insightful perspective. So thanks for joining. I thought we'd do this in two formats. You would take prepared, you've got prepared remarks to share with us, which I think will be beneficial, and then we'll get into some, questions and answers that I know are on the minds of many people. I will tell you, we have a fantastic turnout, and we think that we will have more replays than last Mick Jagger and the Rolling Stones last concert. So we're excited about it. Welcome and thank you.
Thank you, Miles, and thanks for that introduction. Thanks for hosting me. As Miles indicated, there is a lot to chew on these days. I have to say, earlier this year, I was telling people this is one of the most complex economic environments I've seen in my career, and that was before the Russian invasion of Ukraine. That just added another layer of complexity to what's already a very complicated environment. As Miles said, this is a great time to be going over the economic outlook. Even the Fed chairman is talking about the possibility of a recession. We just had the biggest Fed rate hike since 1994 yesterday, and there's lots of chatter today that the Bank of Canada is going to match that when they meet next month. So I think I'll, with your permission, I'll just dive right in. I am going to share a few slides. I'll try to go through this relatively quickly because I think there's, I think the Q&A part will be at least as interesting as what I'm about to tell you. So just starting off, just as a quick recap and where the markets have been in 2022. And the vertical line in each one of these charts indicates the day that Russia invaded Ukraine. So for me, I think the most important implication of that invasion was the run-up in oil prices that we've seen. Now, we've had a sawtooth pattern since the invasion, but the big picture here is, oil prices are up about $25 or $30 from before invasion levels. And that's in turn led to, much more inflation pressure right across the board. We already had a very serious inflation pressure before the invasion, but then it became that much more severe. It's led in turn to a big backup in long-term interest rates. I cannot tell you how big of a move this is in a key interest rate, the 10-year government bond yield in the US. Before the invasion, it was around 2%. Now we're closer to 3.3 or 3.4%. That is an enormous move in a very important interest rate in a very short period of time. And coincident with that, we've also seen quite a bit of strength in the US dollar right across the board, even against our currency. And the reason why that's important is it's very rare to have the US dollar rising at the same time as commodity prices are rising. And what that means is for the rest of the world, for the rest of us, the inflation pressures are actually being amplified because our currencies are actually dropping a little bit, or in some cases a lot, against the US dollar. So, when they quote US dollar oil prices, US dollar commodity prices, well, in our own currency terms, in Canadian dollar terms, in euro terms, they're actually going up even faster, which is amplifying the inflation pressure. Now, I would argue as a result of these three things, we've seen equity markets weaken. We're in a full-on bear market in the S&P 500, for example. I talked a little bit about the divergence between commodity prices and currencies. This is our own currency, the Canadian dollar. I think the big story here is it just has not benefited from the run-up in oil prices we've seen in the last six months or so. If you look back over the last 20, 25 years, there used to be this very, very close relationship between higher oil prices and a higher Canadian dollar. That hasn't worked this year. That's worthy of an entire session on its own as to why that relationship has broken down or disappeared this year. But the key point is we're just not getting the benefit in the Canadian dollar from higher commodity prices, and unfortunately, that means for us as individuals, for we as individuals, we're facing the full inflation pressure when we go to the pumps or when we go to the grocery stores, whereas in the past we were a little bit sheltered. Usually a stronger Canadian dollar would have sheltered us a little bit or protected us a bit from those inflationary forces. It's not happening this cycle. Now, so what does this mean for? Oh, sorry, skipped ahead just a little bit. What does this mean for the global economy? So we came into this year relatively optimistic on global growth. We thought there was still, a little bit of more reopening to go. We'd see more of a bounce in things like tourism, and we are getting that bounce in tourism, by the way, and in entertainment. We thought we'd have an above average year for global growth and North American growth. Well, unfortunately, because of this spike in commodity prices and the run up in inflation, we've had to cut back our growth forecasts almost across the board. So, for instance, for global growth, at the start of the year, we thought things would grow by about 4.5%, which would be strong. That would be well above average, to now closer to 3%, which is actually a below average year for the global economy. And if you look down the right hand column, you can see how much we've cut different economies. We haven't cut Canada by too much, a little bit less than others. But then when you look at places like China that have been dealing with various lockdowns, Britain, Europe, US, you can see a little bit more serious shaves. And of course, Russia, we're looking at quite a deep decline in the Russian economy, but that's obviously a special case. Now, how about North America specifically? Well, much like the global economy, we thought this year would be well above average, especially in Canada. As you may recall, we had more intensive and long-lasting restrictions in Canada over the last couple of years, so we thought we were going to be playing catch up with the U.S. and economy this year. We thought we'd see a very strong year for the Canadian economy and probably another solid year in 2023. Well, unfortunately, Russia got in the way, commodity prices got in the way, higher interest rates are now getting in the way, and now there's all kinds of talk about, the possibility of an outright recession. We're not quite there yet, but we do see growth essentially stalling through the second half of this year and into early 2023. So after, very solid growth rates in Canada and especially the US in the last couple of years, and even at the start of this year, even through the spring, we now see growth essentially flattening right out with the possibility of a little bit of a comeback in late 2023. And this ultimately leads to very modest growth when we add it all up through the remainder of this year and into 2023. Yes, in a word, we've had to trim our sails. Which way do the risks lie to this forecast? I think it's pretty clear that if we're going to be surprised over the next year, the risks are more to the low side rather than to the high side of this forecast. It's very interesting to me how downbeat consumers have become in very short order. By one measure in the US, the University of Michigan survey of consumers, consumer confidence is now at its lowest level in over 40 years. Now, that's not true by the Conference Board. They also do a survey of consumers both in Canada and the US. You can see consumer confidence has come down in both cases, but it's not as low as it got in the early days of the pandemic. It's certainly not as low in the US as it was after the Great Recession back in 2008, 2009. I actually think that's a little bit more representative. I think this weakness that the University of Michigan is finding in their survey is exaggerating things. I think that's really being swayed by gasoline prices. The Conference Board survey tends to be driven more by how consumers are finding the job market, and the job market is certainly in much better shape than, say, the equity market at this point. Maybe the right answer is to take sort of an average of these two surveys. And I think the main message here is consumers have become much, much more cautious just since the start of this year. Now, if there's any good news out there, it's that the job market is still very, very strong. And I often get asked, how can people even be talking about a recession, when we're dealing with one of the lowest unemployment rates that we've ever seen in Canada? Of course, it just came out last Friday that our jobless rate dropped to 5.1%. We haven't seen a 5.1% jobless rate since the early 1970s. In the US, the unemployment rate is now down to 3.6%. They were lower for, a couple months before the pandemic. But really, you have to go all the way back to the 60s since we've seen unemployment rates this low. So all of the damage that we saw during the pandemic has been repaired. And we've got, in Canada, we've got more people employed than we had even before the pandemic began. I know there are many people out there who probably are a little bit skeptical of the unemployment rate and think that, well, this is because people have dropped out or stopped looking for work. That's really not going on in Canada or Europe. We've got as many people as ever out there looking for work, and we've got more people with jobs than we've ever had before. So the job market is very, very strong. So going back to that question, well, how can we even be talking about a possibility of a recession or a downturn if the job market is so strong? Well, the short answer is that, frankly, the job market tends to be a bit of a lagging indicator. It's not a leading indicator. In other words, it follows spending. So first you get the slowdown in spending, then you get a slowdown in output and production and building and construction and that kind of thing, and then it eventually hits the job market. So the job market is one of the last things to really begin to weaken. So frankly, I wouldn't look to the unemployment rate for the early signals that the economy is getting into trouble. It'd be more like confirmation. Now, with our growth forecast, we expect the unemployment rate to actually drift up a little bit over the next year. The reality is that in the past, unemployment rates rarely just drift up. If we get into real weakness, I don't think the pandemic's the greatest example of this, but it is an example. You can see how sharply the unemployment rate deteriorated that time, but that was a special factor. If we go back to the financial crisis, though, you can see the extent to which the unemployment rate deteriorated in a short period of time. So this is a tough trick to pull off for the Bank of Canada and the Federal Reserve, but it is possible that we could just see a modest drift up in the unemployment rate in the coming year. Now let's turn to what really is the root of the issue here. Why are interest rates going up? Why are people even talking about the possibility of a downturn? It's because we have a very serious inflation issue on our hands. That is the nub of the issue here. We've got an inflation rate that we haven't seen in the U.S. in almost 40 years, in Canada in 30 years. Headline inflation in the U.S. that was just reported last Friday rose to 8.6% in May. We haven't had a rate like that since the early 1980s. Even when you strip out food and energy prices, you've still got inflation running at about 6% in the U.S. So we can't blame this entirely on Russia. And by the way, even before the Russian invasion, we were looking at about 6% inflation in the U.S. and about 5% inflation in Canada. So this last leg has been driven by the Russian invasion. But we had an inflation episode in any event, even before the invasion. It's not just in North America. If you look at that table on the right-hand side, that bar chart, you can see that many economies are dealing with very high inflation. In Britain, it's now 9%. In the euro area, it's 8%. In Mexico, it's almost 8%. In Australia, it's 5%. You can see it's a little bit more modest in Japan and China, but even for Japan, 2.5% inflation for Japan is high. They've had basically zero inflation for the last 30 years, so to even have 2% inflation, that's relatively high for Japan. But the main message here is, again, this is not a North American story. This is pretty much a global story. Now, looking ahead, we do see inflation going a little bit higher in the next month or two. But then we think it does moderate and come off. We're assuming that oil prices do moderate in the year ahead. We're assuming that some of the supply chain issues that you probably all heard a little bit about and is really affecting the auto sector in particular. We're assuming that some of those supply chain issues do improve over the next year. So those will help bring inflation down. But even by the end of next year, we still think we're looking at inflation that's a little bit too hot for comfort. We see it in the 3 to 4% range, even by the end of next year. So we still do believe that we have a bit of a lingering inflation episode on our hands, even by late next year. Just for your interest, very briefly, what's driving the inflation? So on the right-hand side, these are the things that have risen the most in price in the last 12 months. This is the percent change in prices over the last 12 months. On the right-hand side, it's a lot of the usual suspects. Gasoline and natural gas, of course, energy prices have really led the way. Almost anything related to the reopening, so hotel and motel rates have gone up a lot. Airfares are also starting to climb as well. Car rentals, it's very difficult to even find a car to rent these days, has gone up a lot. And then as you go down the list, I get a little bit more concerned that these are not just reopening or temporary things. This is more related to the supply chain issues. Things like furniture and appliances have gone up a lot. I just put meat here. Meat is just one aisle of the grocery store, but almost every aisle you do find a bit of sticker shock in the grocery stores right now. We're seeing broad-based strength in grocery prices, and again, this is not a Canadian story. U.S. grocery prices are rising even faster than they are here in Canada. Now, one that's just popped up onto my list recently has been rent. This, of course, is related to the strength of the housing market over the last couple of years. It's a delayed impact that we're now starting to see rents rise. This is the official Stats Canada measure of rents. We've probably all seen in our own livelihood that in some cases rents have risen a lot more than that. But of course, that would include all the rental control buildings as well. So would be an average across the country. Just for your amusement or interest, there actually are some things that have come down in price over the last 12 months, just to show that it isn't completely, not everything is rocketing higher. Things like auto insurance and clothing have actually come down in the last year, but it's getting tougher and tougher to find things that where prices have actually dropped in the past year. Now, I've often been asked, and really the most close cousin we've got to what's going on right now was the 70s. If you didn't live through the 70s, what we had was a combination of a spike in oil prices as OPEC flexed their muscles in the early 1970s, and we had a big run up in grain prices back in the early 1970s, and those combined to lead from inflation going from 3 to 4% in the very early 70s to suddenly double digit almost overnight, it seemed. And at that point, that did lead to a recession. Interest rates went way up. It did bring down inflation, but then we got hit with another energy shock late in the 1970s and more double-digit inflation that led to an even deeper recession in the early 1980s that eventually broke the back of inflation. Now, all I can say is, there are a lot of differences between the 1970s, but there are some eerie similarities, and we're not dismissing that episode as a bit of a guidepost. I frankly don't think we'll get quite as high as we got in the 70s, and hopefully, with a little bit of luck, we won't have to go through the deep recessions that we went through in the 1970s. But as I said, there are some eerie similarities, and we tend to believe that there are still some upside risks to inflation over the next year or two. Some of the things that we would point to, I talked about the strength of the labor market. Well, that's just beginning now to show up in higher wages. In the US, wages are rising by about 6% right now. That's strong, but it's still below inflation. In Canada, we really haven't seen that much wage pressure yet. Our best measures of wages are still rising by about 3% or so. Compared to past years, that's pretty strong, but 3% is a mile below current headline inflation of almost 7%. So now we're starting to hear all kinds of potential labor action. There's talk about a rail strike now. We've seen some construction workers go on strike. The carpenters just earlier this year went on strike. I think that's the thin edge of the wedge, because we've got such a gap between current wages right now running at about 3% and headline inflation of around 7%. I think we're going to see a lot more labor disruption in the next year or so, and that can lead to further pressure on prices. Now, another source, frankly, of inflation has been the roaring housing market we've had over the last couple of years. Even with some cool down, we still got Canadian home prices on average up about 20% from a year ago, and that's really only now just beginning to feed into the CPI. It's only now beginning to feed into the consumer price basket. So there's still a little bit of a sting in the tail for inflation from the strength of the housing market over the last couple of years. Now, given who's on the line, let's now in some of the short time I have left for the prepared remarks, let's focus on the housing market. The yesterday's sales numbers for May, I think, really did show that we are back. The frothy conditions of the last couple of years are well and truly behind us. We haven't really weakened below long-term averages, though. May's number, when you adjusted it for seasonality, is basically right in line with the 10-year average of sales. So after extraordinary strength of the last couple of years, we're now basically back to trend. I personally don't believe that we stop there. I suspect that sales will weaken further in the months ahead, and we're actually going to go a little bit below trend. And of course, one of the question on everyone's mind is, well, what does this mean for prices? Does it mean we're going into a full blown correction? I think quite simply, it depends on the region. Just as every region of the country had a very different market in the last couple of years, I think every region is going to have a somewhat different experience in the next 12 months or so. Frankly, I think those markets that flew closest to the sun in the last couple of years are the ones that are most vulnerable to a correction now. And essentially, that's almost everything south and west of Toronto. The markets pretty much throughout, well, basically the entire Toronto exurb area and everything in the south and west just had a terrific rally in the last couple of years. Places like London and Windsor doubled in price in the last 3 years. Nationally, prices went up by about 50% from the start of the pandemic to last month. But it's the cities that went far and above that I think are most susceptible to a downturn at this point in a full blown correction. Whereas the prairies, really didn't join in nearly to the same extent, and frankly have better fundamentals now. Places like Calgary and Edmonton are well supported by $100 oil, and so I could actually make the case for Calgary prices to rise over the next year. Even as we're seeing corrections in places like Guelph and Kitchener, Waterloo, and London and Windsor. So I think we're going to have a very, very different experience across the country. Officially, based on this measure, and this is the Canadian Real Estate Association's MLS price index that is up 20% in the past year. Our official call is for it nationally to drop by 10% next year. So of course, you're going to get very big variations among different regions. And I would just reinforce the message that 10% decline, stacks up versus the 50% increase that we've seen over the last couple of years or so. And what's behind that? Of course, it's the readjustment in interest rates. Basically, prices had been set at interest rates that were in the 1.5 to 2% zone in the last couple of years, and now they're going to have to readjust to a world where we're looking at interest rates more in the 4 to 5% range over mortgage rates in that sort of territory for a while. I don't believe that we're going to have a quick reversal in these rates. If anything, we've probably got a little bit further to go, especially in variable rates. Just putting the kind of correction we're possibly talking about in some kind of context. This chart looks at a variety of different corrections that we've been through in Canada in the last 30 years or so. The granddaddy of them all was Toronto specifically, but Ontario more generally, from 1989 to the mid 1990s. You can see it took 7 years for that market to before it fully bottomed out, and it took 12 years for that market to get back to its prior peak. That was the most severe housing correction that we've seen in many decades, and I don't believe we're looking at quite that extreme of a correction, but just to level set, what some of the possibilities out there are. We would tend to believe that it's probably going to look something close to what an average correction looks like when we talk about it nationally. In other words, it could take up to 3 years to bottom. And possibly around 6 years to get back to prior peaks, with a decline somewhere in the neighborhood of the low double digits. That would be our best guess at this point for what we're looking at overall. What are some of the support factors? What could offset it? Of course, this year's budget had a lot of measures. This year, some were aimed at actually trying to improve affordability. Some were actually also aimed at helping support first-time buyers. I actually thought the first-time home buyer savings account was an interesting idea, very generous. By the way, if you know anybody who hasn't, who is a first-time buyer, would heavily encourage them to open up one of those accounts by all means. And of course, they were also looking at ways to help support supply. The reality is most of the measures they were talking about either won't have that much of an impact, or some of the bigger, more fundamental measures will take time before they really do have a big, serious impact on the housing market. So, if I had to distill it down to two buckets, one bucket is really it won't do that much. Things like the speculation tax, for instance, or the others that are a little bit more impactful will take a lot longer before they really have a meaningful impact on the housing market. Now, the other big force out there, and of course the one that the housing bulls will always point to as a big support factor, and I do believe that over the medium term and the longer term, this is a very important support factor for the Canadian housing market, and a big differentiator between Canada and the U.S. is immigration. Definitely, the Canadian government wants to make up for lost time. The deep dive we had in immigration during the pandemic, they basically want to make up for that. They've set very aggressive immigration targets over the medium term. I am a big believer that population growth ultimately is an ultimate driver of real home prices over time. If you look at at a chart of population growth versus real home price growth over a long period of time, in the upper right-hand bar where we've got strong population growth and strong home price growth are countries like Canada, New Zealand, Australia. And if you look at the bottom left-hand of that chart where you've got very low population growth or even declining population growth and flat to declining home prices, you've got your Japan, Italy, Spain's of the world. So I am a big believer that immigration growth and population growth are a fundamental support factor for the Canadian housing market over the medium and longer term. But I would stress that the latter part of what I just said, over the medium and longer term, it does determine home prices over the long term. Over the short term, population growth takes a backseat to interest rates. It cannot influence home prices over the short term. Interest rates really are the driver over the short term. And I will give you an example. In Canada, we had some of the strongest population growth that we've ever seen back in 1988, 89, 90, and 91. And that did not help us avoid a very deep downturn in the housing market in the early 1990s, even though we had very, very robust population growth back then, because interest rates just took off like a rocket. We don't see interest rates getting back to the kind of levels that we saw in 1990. So we don't believe we're going to have as deep a correction as we went through in Toronto in the early 1990s. But I think I just bring up that example to point out that while population growth is a good long-term support, it can't overcome the kind of interest rate environment that we're looking at over the short term. So just before I bring Miles back in for Q&A, the last two topics I'll talk about. First of all, interest rates. So as I said, we just had that big 3/4 percentage point hike by the Fed yesterday. Our view is the Bank of Canada is likely to match that when they meet in next month, and we do believe that ultimately from the Bank of Canada's overnight rate, which right now is 1.5%. We think that they will take it to 3.25%. We think the Fed will go roughly to the same neighborhood. So both central banks have another 1.75 percentage point hikes to go. So that will feed directly into prime and variable rates. Another 1.75, just a little bit less than 2 percentage points to go from here for variable rates. Our view is that will be enough to seriously chill the economy when you get up to those kind of rate hikes, especially the speed with which interest rates are going up. We think that will chill the economy. I will tell you, there's a lot of voices out there now, especially. I think they're Johnny-come-latelys, but there's a lot of voices out there who say that that's not going to be nearly enough to cool inflation. There are a lot of folks out there who are saying, we're talking about the Fed will have to raise rates to 4%, to 5%. There are a lot of people out there who don't believe this is going to be nearly enough, and I have to say, if we're going to be wrong, I do think the risks are that I think they're tilted a little bit to the high side of this call, not to the low side. Certainly there is a path, there is a possibility that the bank and the Fed won't have to raise this much, but I do think there are probably more scenarios where the Fed and the bank can actually have to go a little bit more than what we've laid out here. So those are the very short-term interest rates. That's what drives prime and variable lending rates. The longer-term interest rates, I would suggest that a lot of this has already been baked in the cake. So the bond market, what really drives, say, your 5-year fixed rates, a lot of these rate hikes have already been priced into the market. And that's why the longer term, the 5-year rates have gone up so much, because the bond market is way ahead of the Fed and the Bank of Canada here. We've already seen long-term interest rates shoot up. We don't really see them going a whole lot higher from here. Now, again, if we're wrong and those bears out there who say we've got to go up to 4 to 5% are right, then yes, even the long-term rates will have to climb a little bit further from here. But at this stage, we think a lot of the bad news is already priced in to the long end of the bond market, and that those longer, say 5-year fixed rates don't have to go a whole lot higher from current levels. Just a very quick word. If by the way, if there's any good news out there on the fiscal side, going back to the budget, after the horror show that we had during the pandemic when we ran a budget deficit of over $300 billion, the budget deficit is melting very, very quickly as the economy recovers. Revenues have gotten back, and we are almost back to normal in terms of budget deficits right around the country. If there's any shred of good news out there, is that government finances have basically repaired themselves somewhat after the tough sledding they had through the pandemic. The very last thing I'll touch on is how do we as investors deal with high inflation and rising interest rates? And I will tell you, it is a challenge. High inflation is not good for financial markets. This is a playbook that we wheeled out. What sort of assets do offer at least a little bit of protection from rising inflation? And frankly, I'll tell you, the answer is there are not a lot of good options out there. Some of the old, the most trustworthy, those that were seen as the best, the best protections against inflation. Gold, it's really done nothing, this year, which I think has come as a bit of a shock to gold bugs, that gold has not benefited more from the run up of inflation this year. So historically, its return protection has been, we say it's high. It hasn't done much to help this year. At least it hasn't deteriorated. Gold prices have hung in there. Traditionally, real estate is seen as as a good protection, but that comes with an asterisk, because real estate just did so fabulously well in the last couple of years that it came into this in a relatively highly valued situation. I can certainly point to things that are not good inflation protection. Things like long government bonds are not good protection. Growth stocks, speculative assets are not good protection. They're the most vulnerable to rising long-term interest rates. I do believe, ultimately, stocks that are able, companies that are able to pass on price increases to grow their dividends, they will hold up relatively well. But frankly, as I said, a backdrop of rising interest rates, rising inflation, high inflation, it's a challenge for financial markets as a whole. And really, to some extent, you're really just looking at protecting yourself in an environment of high inflation and rising interest rates. On that cheery note, I'll invite Miles in to dig into some of those topics, or any other things that perhaps I didn't touch on.
That's really very helpful and very insightful. So for the benefit of all the participants, let's go through some of the issues systematically, and if you'd be kind enough to give some insight. So the number one focus of the Fed right now is inflation. Explain to all of us, why is inflation their number one focus, and why is it so significant, and what are the implications to us in our lives of high inflation on a more permanent basis?
Yeah, and I think there are two ways to tackle that. And one is an old saying that when you have 10% unemployment, it affects 10% of people in a very negative way. When you have 10% inflation, it affects 100% of people in a very negative way. Everyone is affected by, whether rich, poor, or in between. Everyone is affected by high inflation in not a positive way. And the second way I would answer that is, Jerome Powell basically addressed this issue directly in his press conference yesterday. He essentially said that stable prices or moderate inflation is the bedrock of a successful economy, one that can operate well. Businesses can plan better when they know prices are only going to rise 1 to 2 to 3% a year. They have a hard time planning when inflation is rising anywhere from 5 to 15%. Households can plan better when they know prices are only going to rise 1 to 2% versus 5 to 10 to 15%. It just causes so much, I wouldn't say chaos, but uncertainty for everyone, for individuals. You don't know what to ask for in terms of wages. You don't know what, you don't want to fall behind. You don't know what the right price to pay for something is. You don't just economic decision making gets very, very complex when you've got a lot of variability in inflation. And ultimately it does mean that people have to demand more when they lend money. I'm not going to invest in a bond if it's only going to pay me 1 to 2% when inflation is 6, 7, 8%. I'm going to want 6, 7, 8%. So interest rates will, the longer inflation stays at, around these kind of levels, the more ultimately interest rates are going to drift up to those kind of levels. And much higher interest rates are really bad news for financial markets. They're bad news for real estate. And in a nutshell, that's it. And I guess the very short answer is, at the end of the day, the Bank of Canada and the Federal Reserve, one of their main missions, and it's written in their mandate, is to keep inflation low and stable. And so that at the end of the day, that really is job number one for the Fed and the Bank of Canada.
So about 3 months ago, Powell said that inflation was transitory. And now they have come back and said not only is it transitory, but it has longer term permanent implications. How'd they get it so wrong in such a short period of time?
So that's an excellent question. And in fairness, it actually does date a little bit further back than that. He was, I think he first wheeled out the word transitory, I want to say about spring of last year. And, after about a month of that, when it was kind of obvious to some of us that it wasn't that transitory, I was saying things like, yes, well, dinosaurs were transitory too. But, they did a lot of damage and they hung around a little bit of time before they left. And the other joke I heard is, well, earthquakes are transitory too. They don't last long, but they do a heck of a lot of damage. And the reality is we're learning this inflation, and it was not transitory. I think he's very sorry he ever used that word. Tiff Macklem also used it once, and I think he's really sorry he used it too. Why did they get so wrong? That to me is a good question, because I doubted it at the time. I think what he was trying to convey was some of the pressures were short-lived. It was things like the reopening. Like we had a lot of things that were really held down in price during the pandemic came back. People couldn't fly, they couldn't go to a restaurant, they couldn't go to a Jays game, they couldn't, couldn't not many people were going to hotels during the pandemic. So of course the price of those things collapsed, and then they bounced back. So that led to a temporary burst of inflation by itself. But I think what they really missed was just the mismatch we had in many, many markets. Real estate was one of them, by the way. But maybe better idea were things like autos and refrigerators and appliances. You had this wave of demand globally for stuff. People were really well supported. They had a lot of stimulus checks in the U.S. We had CERB in Canada. People weren't able to spend on services, so they were buying a lot of goods. Well, guess what? At the same time, we were running into all kinds of supply chain logistical issues. So supply was constrained just as we were having a tidal wave of demand, and that led to a surge in the prices of things that hadn't gone anywhere for years. Auto prices had actually been relatively contained. Price of electronics or furniture, appliances did nothing for years and years and years. And then all of a sudden at once, we had this burst of inflation in a lot of different goods that we were used to really seeing next to no inflation for years. Now, unfortunately, between that and higher energy prices, that set off a chain of events where, it started to then lead to, services prices going up too. And then we had a very tight labor market, which, and especially in the US. And so then companies began to bid up wages, and I mentioned earlier we got 6% wage gains now in the U.S. And well, that meant that service companies like restaurants had to start passing on price increases too. And so now we're in a risk where we get into the so-called wage price spiral, where it feeds on itself, and that's what the Fed is trying to cut off at the pass. That's why they're raising rates very aggressively now to try to chop off that before it does develop into something like we saw in the 70s, where it sort of feeds on itself and it builds on itself. And that's what they're trying to cut off by being really aggressive right now.
Talk about their number one objective is inflation. Yesterday, Powell said that he wanted to have 2% inflation. And right now we're at about 8. And there is a concern that even 8 might be still not the high end of where we'll be a year from now. And on the basis of that the bank rate could be as high as 400 basis points or 500 basis points, up from the 3.25 to 3.5 that you're referencing by the end of the year. What happens if, God forbid, there is, 8 or 9% kind of inflation and they have to raise rates to 400 or 500 basis points, up from where are we now, 1.75 or something today? What's the implications and what is the probability of that happening?
So I can start with the implications because it's pretty straightforward. That is the hard landing scenario. That is where, the only debate is going to be how bad is the recession. And I'm not going to sugarcoat it. If they have to raise rates to around 5 or 6% or something like that, we are talking about a recession. In order to bring down inflation pressures, there is no, I don't think there's any getting around that. What are the odds of that? And of course there's a whole spectrum of possibilities between here and there. And I frankly think central bankers need some luck right now. They've had nothing but bad luck in the past year on the inflation front. They need some good luck now. And I would start with oil prices. And if there's any, quiet good news in the last couple of days, it's actually we've actually seen oil prices and gasoline prices, wholesale gasoline prices coming down the mountain in the last couple of days. That's the one thing I watch every day when I walk in the door, or turn on the radio, or boot up my machine. What are oil prices doing? Because I think that's really where a lot of the severe inflation pinch that we're dealing with right now began. I think that's where it's going to end too. We need oil prices to at least moderate. They don't necessarily have to come down a lot, just stop rising. That would really help. On the flip side, that's the one real danger zone I'd be looking for if we had a further bounce in oil prices. I can't rule it out, by the way. That's where we get in the risks of a very hard landing, is if oil prices, shot up another $30 or $40 a barrel. So that's the one real pinch point I'd be looking for. The other area where we could get a bit of luck would be good luck, would be, as demand softens a little bit, everybody's got every Peloton machine they need, everyone's got the sofa, they don't necessarily need another fridge at this point. The demand for goods softens a little bit, the supply chains do begin to improve a bit, automakers are able to start building cars again up to normal. We get a bit of relief on the supply chain side, and some of those goods prices begin to come down. That's where we could get a bit of good luck. But to answer your question directly, in terms of what are the odds of a hard landing, of an outright recession? Unfortunately, I think it's getting close to a coin flip at this point. But again, there's gradients. In terms of that 50% odds of a hard landing, there's the super hard landing where we get up to $150 a barrel or more on oil prices, and the Fed's got to raise rates of 5 or 6%. I give that about a 10 to 20% chance of a really hard landing.
When we're talking about recession is technically 2 consecutive quarters of negative GDP growth, but there's soft landing, hard landing. Quantify, what does it mean? And how bad could a bad scenario be? How good could a good scenario be if we do have a recession?
So we had in Canada, we had a technical recession in 2015, 2016, when oil prices collapsed. We actually had a couple quarters of negative GDP, but we here in Ontario barely felt it because it was almost entirely Alberta centric. So that one really didn't qualify as a full blown recession. You can get episodes like that, where you get this technical, supposedly GDP fell by 2 quarters. That's a rule of thumb. That's not the 2-quarter decline in GDP. That's not a true recession. To me, a true recession is where you get a serious backup in the unemployment rate. It's affecting many industries. So I was just saying a recession is something that affects a broad number of people, a broad number of industries, and goes on for more than just a few months or so. I don't think it's a foregone conclusion that we're going into a recession. I think there is still a possibility that the Fed and the bank can navigate through this.
So talk about the stock market. The S&P 500 hit a peak of 4,800. It was trading at about 23 times earnings, earnings of about $220 per share. We've now softened to, I don't know, call it 16 times earnings. We're now in bear market territory, down 21 or 22%. Leon Cooperman from Omega Advisor on Squawk Box said, if we go into a recession, you could see the S&P down 40% from the peak of 4,800, so call it 2,900 on the S&P. What do you think the likelihood? But other people say, oh, next year they think S&P earnings could be 250, up from 220. Do you have a point of view? And if you just saw a bullish case scenario of where we are on the S&P 500 versus where it might go, and do you have a bearish case scenario?
So I hate to keep harping on inflation, but I think that's ultimately what it comes back to. You know, how aggressive does the Fed have to get to fight inflation? And I think the bullish case is that, you know, some of those things I talked about earlier do go right. You know, we get some moderation, and again, we don't need a big drop, but just, you know, just some stabilization in commodity prices, and we get a better supply chains, and so the Fed doesn't have to be as aggressive in raising interest rates, and you know, and then we soldier through this episode. I think that's the bullish case. The bearish case is that you know, the Fed does have to get in deeply into restrictive territory. They do have to raise rates a lot more than you know, than what we're talking about, and than what's priced into the market. In terms of what we've seen so far in the equities, I would say up to about the past week, really what we were just seeing was a revaluation, a repricing to current interest rates, and it wasn't really building in severe economic weakness. Most of it was just a readjustment, and you know, of course, the initial sell-off really was in the growth stocks. The, you know, the high flying, the Nasdaq, of course, was down 30%. Most of that was just a revaluation to interest rates. It wasn't pricing in economic weakness. You know, we had not really seen a significant change in analysts' earnings expectations, so they weren't really building in economic weakness. That would be the next shoe to drop. You know, if you know, if there is a view that, hey, the Fed's got to be a lot tougher than what we've thought to this point, we've actually got to scale back our earnings estimate. That would be the next level, and that's where you get into the sort of the Cooperman views of the world. And you know, frankly, past bear markets, 40% is entirely doable. You know, if we are headed towards the less good scenario for the economy and for rates, 40% is certainly doable.
One of the surprises was retailers, the earnings of the retailers. Walmart's numbers were poor, Target's numbers were poor. Was that a surprise to you? And is that a precursor to corporate earnings on a broader scale?
It is a little bit of a surprise to me that some of the bigger retailers got in, where, you know, we're finding difficulties almost right off the bat. There's a couple things I would point to that put a bit of an asterisk on Walmart and Target. First of all, you know, when we look at who do they cater to? They tend to cater to the middle to lower income quintiles, and those are the folks that are being most directly affected by the run up in gas and food prices. They're the ones who are really being pinched the hardest. So other, you know, higher end retailers aren't facing quite the same difficulties. Some are actually doing better than expected. So that's part of the story. The other part of the story is, you know, if you go back to what I talked about earlier, how people couldn't spend on services during the pandemic, they could spend on goods. Well, anybody who sold stuff, you know, did extremely well in the last couple of years. People who sold services did horrendously. Well, now we're beginning to see a rotation. People are able to travel again. They are able to go to Jays games again. They are able to go to concerts, and that's what they're doing. And they're spending less on stuff. You know, retail sales in the U.S. in the first half of this year were still way above trend. I actually personally think retail sales have got to fade a bit in the next year. And meanwhile, we're going to see services get back to normal. So there's going to be a rotation, we believe, for consumers, and I think to some extent that's true in Canada as well. A rotation away from buying stuff and back to buying goods. Well, sorry, services. Who loses out there? Well, people who sell goods, who sell stuff. The Walmarts and the Targets of the world are going to face a bit of tougher sledding, I think.
Oil prices. So in Canada, obviously, we should, in theory, be the beneficiary of much higher oil prices. As you articulated, though, it hasn't really reflected itself in the dollar relative to the US dollar. And has it really affected the economy and GDP growth in light of the fact that we export a good chunk of our oil? If it hasn't, will it? And if not, why?
Yeah, and as I said, this is really worthy of a whole hour topic or seminar on its own. But very very briefly, first of all, high oil prices are less of a negative for Canada than almost every other industrialized world. I wouldn't quite say they're a positive. It's a mixed blessing for sure. It's great for Alberta. It's a bit tough on the rest of us, and that tends to balance out. But for places like Europe and Japan, it is bad news. Full stop. Higher oil prices. It's not bad news for Canada. It's a bit of a mixed blessing. Why is it not benefiting the Canadian dollar? Well, I think some of it is the benefits just aren't as big as they would have been in the past. Whether it's ESG pressures on companies or the lack of pipeline capacity. What you're seeing is oil prices are going up. Oil companies and energy companies, what are they doing? Well, they're buying back shares or they're boosting their dividends. They're not reinvesting in a big way. They're not hiring more people. They're not engaging in a lot more capital spending like they might have 10 years ago. So, sure, it's still a positive, just not as big of a positive as it would have been 10 years ago. The other reason I would say it's not really benefiting the Canadian dollar to the same extent is think of the Canadian dollar as a relative price versus the US dollar. Well, what's also changed in the last 10 years? The US is a much bigger oil producer than they were 10 years ago. So the relative benefits of Canada versus the US are not nearly as big as they were 10 years ago. If you went back 10 or 15 years ago, the US was a huge oil importer. Now they're almost neutral. They import a lot from us, but then they export some through the southern. They're almost self-sufficient in energy. So it's really not the relative benefit for Canada versus the US isn't as big of a deal. And the last thing I'll say is, by the way, and both you and I, Miles, were just in Europe recently, and we saw it for ourselves. The Canadian dollar has actually done very well against the euro. It's actually up a lot. It's up a lot versus the pound. It's up for a lot versus the yen. So it's not like the Canadian dollar is suffering here. We're actually keeping pace or almost keeping pace with a rapidly rising U.S. dollar. So to some extent, that relationship hasn't completely gone away because the Canadian dollar is strengthening a lot versus the euro and the yen.
What a lot of the people that are on the call are involved actively in real estate. A lot of them are in the residential real estate business. They've been the beneficiary of a low interest rate environment, low mortgage rates. I mean, yesterday, the mortgage rates in the United States ticked above 6%. I mean, that's up almost 100% from where it was sort of 18 months ago, kind of thing. Rates in Canada are, almost at 5%. That has, the low interest rate environment is what peaked demand, volume of transactions, and price appreciation. Where do you think we are relative to the psychological level where there is a profound negative impact on the demand for residential real estate in Canada because of the appreciation in rates? And how much higher can mortgage rates go over the next 18 months?
Yeah, first of all, I really wish we could open it up to everybody out there because I'd love to hear, if we could do a survey of the people on the call. I'd love to hear what they're seeing in recent days, and I do hear somewhat different stories around the country and even around the GTA, for instance. But I think there's there's still new price discovery going on here. I think the market is still trying to digest and absorb the very different interest rate landscape that we're looking at than we thought, as recently as 6 months ago. And frankly, even we as interest rate forecasters have been, somewhat caught flat-footed, both by how quickly inflation shot up, and part of it was the Russian invasion, but also how quickly central banks have changed their tune. As recently as late last year, to your point earlier, Powell was really not even sounding like he was going to raise interest rates in 2022, let alone what they've already done. It's amazing how quickly tune of central bankers has changed, and and the real estate market is now going to have to deal with this very rapid change in the landscape that we've seen in interest rates. And frankly, it's tough to see a case where we're going to back down on interest rates anytime soon. In fact, as I mentioned, I think the risks are still to the high side of our forecast. If there's anything I can tell you, again, I would good news, I guess. I would stress I do believe a lot of that's already priced into the longer term fixed rates. A lot of that new news on the interest rate front is built into the longer fixed rates. It's the variable rates that's still got a long way to go here. What does that mean for prices? Again, as I said, I think it really does depend on the market. Did your local market really overshoot its fundamentals and now has to get seriously repriced, or is it like a Calgary that really didn't enjoy the boom of the last couple of years and still has very strong fundamentals? So there's quite a different story across the country. I would say the GTA, big ace in the hole for the GTA. I talked a lot about population growth. It's definitely got that going for it. That ultimately will act as a floor. It's also got a very strong underlying economic backdrop. It's got a good story on that front. So I think there's a bit more support in the GTA than some of the other, peripheral markets when we move outside of the GTA that I think are a little bit more susceptible. And we're probably driven more by investor demand in the last couple of years, and probably have much more downside. And I'm thinking of, again, the Guelphs and the Londons and the Cambridges and the Sarnias and the Windsors of the world that are probably most vulnerable to a full blown correction here.
But the other thing is Mohamed El-Erian talked today that that high inflation will have a negative impact in the short term on housing. On the other hand, it will also decrease supply, which ultimately will increase pricing, so that it actually could have a boomerang effect, that the affordability of housing could continue to get away from millennials and first-time homebuyers, because supply chain costs keep increasing. So the replacement cost of most residential real estate continues to increase, and it doesn't seem like there is much relief in sight. Wouldn't you agree?
Yeah, I don't dismiss that. And by the way, if you go back to my my final little table there, and what assets tend to do well in an inflationary environment, well, historically real estate has tended to do well. Obviously real estate, the initial surge in interest rates is poison for real estate, but the 70s were a very interesting time for real estate that went through some real boom bust cycles during that very, very high inflation episode. But it was certainly not all bad news. We also had some pretty severe demographic shifts during that episode as well. But I think the main message is it's complicated. There are obviously a lot of moving parts, and I definitely take your point on the supply side. I didn't talk much about the supply side. That is a very important element, and I don't at all dismiss your main contention there that we could have a boomerang on the other side of this once interest rates peak out and possibly even back down a bit. We could have renewed strength in real estate markets.
For those of us that are older, the rates aren't that high in relation to what we've experienced. I mean, when I started business, interest rates went from 11 to 22%. A 3 or 4%, Fed funds rate is not like exorbitant in relation to history. Why is everybody so outraged about it? Is it because we got too comfortable with a 0 to 1% kind of Fed fund rate?
I would say yes. There's a lot of short-termism out there. It's what was happening yesterday rather than what was happening 40 or 50 years ago. But absolutely, I mean, and unfortunately, there is a slightly darker side to what you just said. Not that we're going to 21% interest rates, but maybe it will take positive real interest rates to crush inflation. In other words, interest rates will have to go above core inflation to really bring it in. And in the U.S., core inflation is around 6%, and in Canada it's between 4% and 5%. And maybe that's the dark side here, is that it will take rates of those kind of levels to really bring inflation to heel.
So the last question, I guess, and I think it's on everyone's mind, is how, I mean, you obviously don't have a crystal ball, but how, everyone wants to know, how long will we be in this position of uncertainty? By the end of 2023, if you were to sort of hazard a probability, do you think things will feel a lot more in control than they do today?
I want to believe so. So one, of course, one of the big wild cards out there is the war in Ukraine. It's kind of left the front pages of the newscasts these days. But ultimately, some kind of stabilization there, and a bit more clarity on sanctions and commodity markets would help a lot in terms of getting a better grip on where exactly inflation is headed. I also think by that point we will know how far. Well, of course, we'll know how far the Fed had to go to contain inflation. So I think there will be more certainty by that point. Yes. All I can say is let's all hope for some better luck for central bankers in terms of inflation. Whether it's calmer oil prices, calmer grain prices, better supply chains, that would be good for all of us because it would help control inflation. It would mean rates wouldn't have to go as high, and it would mean a better economic outcome for us all.
Terrific. Well, look, Douglas, I first of all, I wanted to say, Jeff, thank you to you and all of our friends and colleagues at the Bank of Montreal, not only for your unconditional support over the last 30 years, but for organizing this. Douglas, you're always fantastically insightful. I don't think your timing could have been better to share with us your wisdom and experience and insights. It is very valuable. On behalf of all of our colleagues, partners, families, and friends at Peerage and our partner firms, we really appreciate it. I'm going to propose, if we could, to post somewhere the information that you put forth, because I don't know how many people we have on the call, but I think we have several hundred. And I think they would be very, very interested if you would be kind enough to enable us to do that. I think it would be very valuable. We'll look forward to doing this again later on in the year. We hope everybody enjoys their summer. Thank you very much for your participation and your interest. And we wish everybody good health and a wonderful summer. And let's hope all these issues start to look better in hindsight.
Absolutely. Thanks, Miles. Bye, everyone.
Take care. Bye-bye.
Thank you.